Hello, investors and traders, and welcome to the Midweek Report. I'm AJ Monte, Chief Technical Analyst with Sticky Trades, and I'm recording this while the markets are open just prior to the close on this Wednesday, January 17th. We have a live event here in Fort Myers, so we have a packed schedule. If you're here, I'm looking forward to seeing you, especially for the first round of public webinars that are happening tonight from 6 to 7 p.m. here at Fort Myers at the Luminary Hotel. Before we get into the charts, I just want to point out that all of the analysis that I do, or I should say 99% of it, we got that 99% coming up week after week. 99% of the analysis that I do is based on the 7-point trading checklist. Outside of that, I will also do pattern recognition. I'm not going to get into that today, but I will be focused on the 7-point trading checklist. The Dow and the rest of the markets are under some pressure today. The IMF came out and says that market bets on rate cuts are premature. So the bulls got a little nervous on that one over the past couple of days. Whether or not this will continue throughout the rest of the week, we'll have to see. However, I believe that we are going to see a little bit of a bounce from here. I'll show you why. If you take a look at that little candle, it's very close to an inverted hammer. That's more bullish than bearish. Remember, I'm taking my trading checklist and applying that to this chart. Longer term, I still think we're going to hit that downside target, but I think tomorrow and or Friday, we could see a bounce up to that moving average, and then that moving average will revert back to resistance, and we'll have to see if it goes lower for the rest of the month. But that is my outlook for the rest of this week. The other confirmation of that being a strong possibility is that the CCI is starting to hinge down here after already being in an oversold condition. So I rely heavily on the CCI, and so if we start to see a full-fledged pivot, that could rally the markets over the next couple of days. So again, stay tuned for that. Now, if we go to IWM has hit my downside target already, and that too looks very much like an inverted hammer with a slight gap above the market here. So now that we've hit that downside gap, I'm not going to put a price target on that because I'm going to leave that for Friday, as I like to leave my targets on the charts for confirmation and reference. But I do think we'll see a little bit more of a rally in IWM over the next couple of days. Looking at QQQ, didn't quite hit the downside target, at least not yet, but we are on our way. We might see a little bit more selling tomorrow to actually hit that target. And then what we'll have to see is whether or not it gets back up over that 20-period moving average. This whole area back here at these most recent highs is going to be resistance. So I think that we could, again, hit that downside target, maybe get a little bit of a bounce, and then into next week, I think we'll start heading lower, especially with this Friday being options expiration Friday. We tend to see more volatility in the week that follows the monthly expiration, and so that could very well play into more downside action for the general markets. Now, if we look at SPY, you can see here that we are now closing below that 20-period moving average. The volume is light. We haven't hit that yet, but remember, this was a two-part forecast. We hit my upside target on SPY. We're still waiting to see whether or not we're going to hit the downside. Just like the Qs, I think S&P could go a little bit lower, mainly because if you look at the CCI down here, we crossed below that zero line. The only thing that would really confirm that to be lower for me would be a higher volume day, but we're not getting that. So it's going to be mixed signals here. A lower volume day tends to be more bullish when the price is dropping, but again, that CCI is very reliable. So we'll have to see how that pans out. I'm still going to keep that downside target of 464.91, but like I said, over the next couple of days, we might see a little bit of a bounce. Here's another reason why I think we could see a bounce. If you look at the VIX, we gapped up yesterday. So this VIX could actually drop back down to fill the gap, which would rally the S&P 500. You see, so we got a lot of conflict in the technical signals, so I can't really feel very comfortable about any extended brand spanking new bearish positions. But I'll tell you one thing, once that gap fills, like it does the large majority of the time, you generally get a pivot back up, and then I think the VIX could be on its way to hitting my target up here around 18 11. So that is it for today. For those of you that are going to be on my rapid fire session, please remember and check your email that we moved that 1 hour early. We're starting at 5 instead of 6 because of the live event here in Fort Myers. If you're brand new and looking to get tuned into Sticky Trades, just go stickytrades.com and you can sign up for some of our services and plug right into the webinars. So have a great rest of the week, folks. So long.